Good morning, everybody. Hope you are doing very well this Wednesday. If anybody was celebrating Midsummer, I hope it was fantastic. Going back to the money supply, going back to Bitcoin as always. I'm going to do a little lecture here, as always, on what is the apples to apples comparison with Bitcoin. For the 1000th time, people on Twitter or in the econosphere seem to compare Bitcoin with the M2 money supply, and that is wrong on every single level. Bitcoin is not comparable to M2 money, which involves deposits and fiduciary media and claims and instruments that are issued by individual banks and entities and hedge funds. Bitcoin has nothing to do with any of that. If you're going to compare Bitcoin to the fiat world, it's going to be compared to the monetary base. In addition, in the Twitter sphere, econosphere, when people are trying to show how much liquidity or monetary liquidity is introduced into the system, they tend to use this mystical M2 number, which is just incorrect. It's not correct. It is not all of the deposits that are available in the banking system. So two things to sort through here. I have it in the title. All right. So for fiat, it's M3, not M2. That's the broadest money supply. And for BTC, it's MB, not M3. You can make all the comparisons that you want, but economically, apples to apples, ontologically, it is, as I am pointing out here, very exciting, right? Very exciting. So let's go through it. Here is a post that Nick Carter made last week. All right, and he's quoting Bessent's comments, Treasury Secretary Bessent's comments about the Genius Act. With it about to pass, it's possible that over the next 10 years, stables could reach 3.7 trillion in economic value. All right, that's the main point I want to talk about here. The whole point of his post is just, again, it's, as I always say, the dollar is the best looking horse in the glue factory. Other currencies are going to be very difficult. It's going to be very difficult for them to keep up with the dollar. And the dollar's not going away for some long time to come. Nick is actually, I did this quick calculation now. I don't know. He's probably taking a different M3 estimate. There are many online, but this is incorrect. I think it's not going to be this high. It's even less. And the point of that is to show you how huge M3 actually is. So I'll try to do that right now. Okay. So if you do 3.7 trillion divided by 13%, he gets about 28 trillion. That is indeed higher than M2. M2 right now is about $21 trillion. This is all US money supply. But my M3, as I calculate, is even higher than that. And the true M3 is probably even higher than that because my M3 doesn't include eurodollars, which is a very nebulous, difficult to calculate money supply. So, with all that fun stuff out of the way, let's show you exactly what is in M3. When I say M3, this means everything that is above M2. I'm going to build it out for you here. Okay, this is going to be an M3 money breakdown for the United States dollar. This is the non-M2 portion. All right. As I've said many times, the Federal Reserve has not calculated M3 since 2006. And there probably are some clues there as to why and how the global financial crisis even happened, because they weren't even calculating the money supply that a big part of that caused the crisis. Primarily eurodollars and repurchase agreements. All right. We'll get there. But just to show you how big this money supply is, even though they don't calculate it, you can back into most of it. All right, so that's what I've done here. Unfortunately, it took them a long time with Dodd-Frank after the global financial crisis. They were forced to try to provide more clarity on all this junk that they lost control of at the global financial crisis. I'll show you how it all shakes out. All right. So again, we're looking at M3 money. So broadly, what is M3 money compared to, say, M1 money or M2 money? All right. Very simply, M1 money is that sacred checking account demand deposit. The Austrians like to think that this is somehow a sacred money supply. It's not. It's just demand deposits. M2 is retail type deposits that are not demand deposits. Okay, so a time deposit is a common one, right? You might give the bank some money for a certain amount of time. You'll get a higher deposit, a CD, certificate of deposit, time deposit, interest rate, but you will be penalized if you take the money out earlier. So the bank, that's so the bank can manage that cash flow better. Other things, savings deposits are in M2. In the United States, the law has been changed so many times that it's kind of stupid. The Federal Reserve in 2020 basically made M1 the same as M2. Again, they've done so many stupid things with the money supply, not backwards compatible. But traditionally, savings deposits are in M2, as well as retail money market funds. And that's it. So smaller, credit unions, all those type things, everything basically for retail. That's what we call M2 money. All right. It's beyond that magical demand deposit, which is not that magical, but it's not including a very important component of the money supply, and that is the M3 money supply. So what is the M3 money supply? It is institutional money. Institutional. All right. So it's going to be large. As the United States breaks it down, they call it large time deposits. It's basically just huge. Of course, there can be individuals in here, some rich, high net worth people, but for time deposits, they break it down in small, under 100K, and then large, over 100K time deposits. Institutional money market funds, repurchase agreements, and eurodollars. As I said, eurodollars is a bit of a fly in the ointment. It's not included in mine. We'll get there. All right, so this is the M3 money breakdown, just M3. All right, so that means non-M2. It's the non-M2 portion of M3. You'd think they'd find some better verbiage for these things, but they don't have it. All right, so here's large time deposits. All right, this is a large time deposit. Anybody who is a corporate or a big retail investor who has over 100K in a bank, it's here. You can see before GFC, we got over to $2 trillion. Fell down a little bit, down, and then liquidity from everybody's favorite pandemic started, and this is now at an all-time high, $2.3 trillion. This is M3 money. This is not in your M2 that you're going to see everywhere over Twitter where people say it's the most liquid money supply or broadest money supply. It's not the broadest money supply. M3 is. But the Fed doesn't calculate it anymore. All right, so this is large time deposits. Next thing up, institutional money market funds. I can take off the time deposits so we can just see it on its own. This is how it looks. Okay, institutional money market funds. Big pop here again before the GFC. Too much liquidity, too much risk in the market. Came off, went sideways, and then again from the old pandemic. Super high, all-time highs, $5.2 trillion in institutional money market funds today. Now, the repurchase agreement market is confusing to people, but basically what it means is this is how treasuries trade in institutions, in hedge funds, money market funds, all around. They slosh around the system. It's basically a treasury trading like cash. That's what you need to think about a repurchase agreement. It's a treasury trading like cash. It's levered. It's certainly riskier than a normal treasury because a normal treasury, you just buy it from the treasury and you hold it like in your drawer or something. Used to get those Treasury certificates. I know I got them from my grandparents. Perhaps some people did as well. These are liquid tradable treasuries. That's what the repurchase market is. Okay. So I'm going to add that on now. So first of all, let's put the time deposits back, money market funds. All right. In total, you got 7.5 trillion already in M3 money. Okay, so now let's take these off and let's look at the repurchase agreement market. Okay, we'll put up repurchase agreements first. This is a very basic thing: commercial bank repos. This is sort of vanilla trading of treasuries in the banking sector. It's actually not that large. And this was what they, as by my estimation, they're not completely clear on it, to be honest, but by my estimation, this is what they stopped publishing in February 2006, was the commercial bank sector of repurchase agreements. It's only about, this was the number, $574 billion of repos. This is not the entire repo market. But the Federal Reserve decided to stop publishing this, which was a clue that perhaps things weren't good. They restarted again after Dodd-Frank and more requirements necessary on a quarterly basis, which is why this looks more jaggedy here. And there's just literally no data here. So I have to regress to, just to make it up of what we don't really know what happened here. Interestingly, during the GFC. But it's not that much money in the grand scheme. It is higher than it almost as it's ever been. Was peaked out at 800 billion in June 2024. Now it's 700 billion. All right, these are treasuries, liquid treasuries that are trading around banks in the U.S. The next thing in the repo market is shadow bank repos. This is huge. Federal Reserve, of course, has the data. They don't publish all of it, but they have some of it. And it's something going to be like this. Okay, so you can see shadow bank repos dwarf commercial bank repos. Again, what are shadow bank repos? These are basically repos, treasuries that are trading around, being levered up, being used as collateral in many different institutions: hedge funds, money market funds, pension funds. Wall Street is playing a lot with these instruments. Huge run up before the GFC. This is probably a clue why they stopped publishing M3. They were losing control of this money supply. Look, even in 2006, look here. This is when they stopped publishing it. All right, shadow bank value I have is 2.6 trillion. By the time it was said and done, another trillion was stacked on to these babies. Collapsed again after the GFC. People get wiped out. Liquidity is destroyed. The United States was good, at least. Didn't bail out everybody. They bailed out a lot of people, but they didn't bail out everybody. A lot of people lost money here. Kind of went sideways for a while. And now it's back up to an all-time high. In fact, almost double what it was GFC. All right, it's pretty high. But there's more going on even here than meets the eye because the Fed is involved. All right, so remember again, commercial bank is here. I'll take it off. Put it back on. Take it off. Put it back on. Commercial bank is this smaller stuff. Sort of, you could say this is almost like regulated, bank regulated trading of and levering up of treasuries. The unregulated sector is what they call the shadow bank. That's the hedge funds, the pension funds. Much bigger. Much bigger. But like I said, this is not everything when it comes to the repo market because the Fed is involved. Right? So when the Fed gets involved, it's actually a negative on the net liquidity of the system, but it's definitely a liquid asset for people who repo with the Fed. And it can be huge. So I'm going to put what the Fed did here. As you can see, compared to way back here, this stuff was rounding to zero when the Fed was involved in the repo market. All right. $35 billion here before the GFC. But they really started to get involved here in COVID. This was a major market distorting event. And even from here, you can see a little bit more, right? Hundreds of billions now the Fed is repoing with players in the market. Here they went up to 2.4 trillion. This is what they call the old Fed repo facility. It's actually it's a repo for the Fed. It's a liability for the Fed. It's a reverse repo for whoever's trading with the Fed. Reverse repos are assets, repos are liabilities. It's not important. What this did, though, is it stopped inflation, kind of like what they did with the bank reserves in 2008, 9, and 10, and 11, 12, with QE 1, 2, and 3. They provided a lot of banks with bailout bank reserves. They paid interest on those bank reserves. That's what they did here with the repo facility. But this is basically for non-banks, for hedge funds, for pension funds, money market funds. And so what that does is it provides liquidity, but it provides a distortion in the market because this took, look at number 4, which is basically, it's not the total, but it's nearly the total, right? 3.9 trillion in shadow bank repos. It's not really rising here as COVID is raging because the Fed is providing liquidity. So the hope and why they did this is that there wouldn't be, too much inflation in the markets with all of that liquidity. They would again just say, look, repo with us, park your reserves with us, not your reserves, park your treasuries with us. We'll pay you interest, and everything will be okay. Of course, that can't go on forever. Central bank, just like the central bank can't print money forever, they have to put it back into the market at some point. So you can very clearly see here that it leaves the Fed, what they've been trying to do as they've been raising interest rates, leaves the Fed, it goes back into the market. So that's what's happened. There's been repos that were hanging around in the Fed for about 2-3 years, and now they're back in the marketplace. Could be dangerous. Could be. Could be inflationary. Greetings, Bitcoin Polska. Love that name. Hope you're doing well. Greetings from the Baltics. One thing I thought was funny, and again, this is such a lagging indicator. I just have first quarter data in now. If you look here, actually, let's take everything off. Just the Fed repos, okay? This is just the Fed. This is why it's a negative, because it takes away liquidity from the system. Zoom in. It did go up in the last quarter, right? So here, a little bit. Fed is bailing out a few other people, a few institutions. We'll see how long that lasts. Maybe it's just a blip in the trend down, but could be rough. But anyway, the Fed did not used to be involved in the M3 market. Now they are. All right. And this is the M3 market. This is M3 money. All right. So I'm going to put it back on now. Large time deposits, institutional money market funds, commercial bank repos, not that big, shadow bank repos, way bigger. And if you add all them up, all right, you get to a number that is something like 15 trillion. I actually need the axis here so I don't. Let me just add it, whatever. Let's say 6.8, 7, 13, 15, 3. So, and then the Fed is taking that down a little bit, right? They're taking some liquidity out. But bottom line, this is what is happening in the market. This is M3 money, right? The Federal Reserve hasn't published it in nearly 20 years, but it is still there, still exists. People are still playing with treasuries, betting, hedging, shorting, long. There's many reasons why you would repo, but basically repo is additional risk on a treasury. Okay, so Like I said, you could just buy a Treasury directly from the Treasury, Treasury Direct, hold it, get paid interest from the Treasury. But people don't like that. They like a little bit more risk, a little bit less safety. Causes risk in the system. Sometimes it goes wrong. This is the size of that market. It's pretty big. All right, so 15 trillion. Oh, thank you for helping me there. Hi, Tim. Always missed this. Sorry. There we go. Switching windows, switching programs, but yeah, there we go. So if I did what I was saying before is, if you look here, a little bit of a blip, more. This is bailout money. This is bailout money. All right, so Fed is interestingly helping out the old institutional market a little bit more than they have been over the last 2-3 years. Could just be a blip. It's very slow data. I only have from March. It's now June. It's not going to be till like September, probably, till I get the June numbers. But that's what it is. All right. So this is M3 money. This is the makeup of M3 money. And then another important thing to say here is I don't even have eurodollars. Okay. So what are eurodollars? Those are dollar denominated deposits in banks abroad, basically. Offshore dollars. Banks in the Caribbean, banks in Europe. That's where the name eurodollar comes from. It doesn't have anything to do with the euro. It just means banks in Europe that hold dollars. To be sure, a eurodollar can be many things, right? It could be a repurchase agreement, could be just a regular checking deposit for someone abroad, but they just lump it all together and it's completely gone. I mean, no one has any idea. From the 80s, they've lost track of eurodollars, but that could be another 10 trillion. No one actually knows the value of that. Maybe the Fed has some idea, but they don't tell us. But here's another thing to say about this. Okay, so back to the stablecoin idea, the 3.7 trillion. Which again, this is not the correct number. I'll show you what it will be. But stablecoins are kind of a combination of money market funds, this value, which is huge. All right, this is just institutional. There's also retail inside M2, which I'm not showing. But this is institutional money market funds and eurodollars. That's basically what a stablecoin is. It's a blend of a money market fund is basically if you have a stock, you sell the stock, and in your brokerage account, you get something that looks like cash. It's just cash, right? It's dollar denominated cash. But it's a money market fund. It's not guaranteed by the government. It's just something different. That's what a stablecoin is. It's not guaranteed by the government. It's a representation of a dollar. And the issuer of that token, the issuer of the money market fund, holds treasuries. Okay, so another way, it is also another way of saying a different way to hold treasuries, but it's a much safer way, by the way, than repos, because here, at least theoretically, there's just the token or the money market fund, and then on the other side, the issuer has treasuries on their balance sheet, and they collect interest to pay their cost of operations. And the difference in that spread is their profit. It's pretty basic business. But it's huge. I mean, it's a huge sector of the economy is the money market fund. That's 5 trillion. And then, like I said, the thing that I do not have charted in this M3 is eurodollars because it's just kind of mystical. I thought about ways to get proxy eurodollars, like look at publicly traded companies. Sometimes you can see the dollars that they hold. But I don't have it yet. The only way to actually do this is to look at each central bank's money supply. And then from there, you can sometimes see foreign currency in the system. And you would presume that most of the currency is dollars. It's not always. It's probably, you can slap even 50% of that. But you have to go to each system, to each monetary system to find it. Find how many eurodollars there actually are. But obviously, just to make the point, stablecoins are going to go into that market specifically. They will go into money market funds and they will go into this nebulous eurodollar market, which is a huge market. It's a huge market. So when people say that the dollar is going to zero, or Max Kaiser says the dollar is going to zero after he deletes 2,000 tweets that Ukraine is not going to be invaded by Russia, they're not giving away this power anytime soon. You can talk about how their hand's going to be forced, even if there's another GFC type event. They're not giving away the power. This is not going away. So the liquidity is huge. It's gigantic. I think it's good for Bitcoin. But this is nothing like anybody who thinks that this is going to zero is just, it's not going to happen. All right. So this is M3 money. Let's put it all together now. Okay. Here it is. All right, let's break it up again. Let's go back down to the very beginning, just so you see the whole money supply. This is the bank reserves. Again, this I mentioned earlier. This is the actual bailout money that they gave to banks after the global financial crisis. You can see it was under 100 billion before the crisis. Now it's 3.5 trillion. Okay, this is literally the printing press. The other side of the printing press is M0, which is publicly facing money. That's why we put it above the line. This is the actual cash you and I can hold. That number is 2.2 trillion now. You see it spiked here. Trillion higher than 5 years ago. I'm looking at M0. It's called M0, physical cash in circulation. We'll put those Fed repos in. All right, this is I showed you here on this chart. Remember, it's this. It's basically, this is bailout money for non-banks, bailout money for hedge funds, pension funds. Okay, they're trying to destroy it. They're trying to make the market free again. We'll see how long it lasts. M1 includes M0, and it includes that sacred demand deposit that Austrians think is such a big deal. They don't publish this anymore because they're not helpful, in my opinion. Like I said, savings deposits are included in demand deposits. But anyway, it's savings deposits and demand deposits are basically the same thing. So it's now part of M1. You're going to see crazy charts if you look at the Fed. Like, you'll see this spike up like another 5 trillion higher or something. It doesn't make any sense. But this is roughly, I've backed into what the demand deposits are here. And they're big. Obviously, you see a lot of printing money after pandemic. M2, remember what's the difference between M2 and M3? This is all retail other instruments. So your saving deposits are in here, retail money market funds, retail time deposits. All right. And these are inclusive numbers, by the way. So 21 trillion is total M2. Here's that old M3 that they stopped publishing in 2006. They stopped publishing at 10.3 trillion. But if you back into the numbers that I have, which they still publish, right, we'll start to add it on. First, without repos. Okay, so without those, this just includes large time deposits and money market funds for corporates, for institutions, hedge funds, pension funds. Still smaller. But then once you add those repos in, much bigger. So that is the total money supply, the black number 3. At least what we can calculate, 36.3 trillion. 36.3 trillion. And if you go back to this number from Nick Carter, 3.7, he's not way off, but I like to be precise. It's more like 10% of M3 is what Besant is talking about, where stablecoins could go into treasuries. So this is how the market looks. And it's massive. It's a big market. Here are the multiples. Let's just make it simple. Let's make it simple. Again, we're in a totally different world than we were pre-GFC. Okay, everybody thought things were normal. There's nothing here you can tell on this chart that GFC is going to happen, except for actually M3 money's kind of rising fast, as you see here. But it's very hard to tell. Then massive bailouts. Bernanke bails out Greenspan and the rest of the world. Now it's very hard to sort of understand because this multiple is way different. like we're way over collateralized in the banking system compared to what we used to be. This is, this is demand deposits. This is the multiple we're looking at. Okay. So demand deposits divided by bank reserves and that little bit of vault cash that banks hold. Usually about 10x, sometimes 14x, 10x. This is your 10% fractional reserve banking idea. But now it doesn't even make any sense. Now we're at 2.2x. These guys are obviously afraid of risk. If they'd let all the bad actors just bail out, we would have been back at it and things would have been fine. But of course, we know they didn't do that. And then if we take away M1, we just look at pure M3 money, which includes all this that I just talked about, all these different shadow bank repos, commercial bank repos, money market funds, all the rest for institutions and individuals. We get this figure again, big number, $36.3 trillion. You actually got to take away the M0 because M0 is included in M3, so M0 is here, right? Because M0 is, you don't really say that it's levered upon. People have cash in, in their bedroom. They have cash in grocery store tills. You can lever cash, like if you're a big cash business, like I don't know, if you run a private ATM and cash is a big part of your assets, then you can lever that up. But technically, we don't say that it usually does. So we can do this number now. And this is something where you can kind of see, obviously, something's out of whack. No one knew that this was the number. Peter Schiff was good at calling here. Everybody's favorite Peter Schiff. But no one knew for sure that this 115x over M0 was like the highest. It was definitely getting bad. The Fed knew it was bad. That's why the Fed stopped publishing M3. Right? They were losing control of it. And by the way, this data wasn't available right here. Right? They stopped publishing right around here. Feb 2006. And then the only reason I can do this is I can go back after Dodd-Frank and a lot of the Fed republications to do this. But now it doesn't make any sense again, right? So M3 is only, and TFL is total Fed liabilities now. So we add in those Fed repos on the negative side. So we're now only, quote, only 8.2x levered. Just difficult to tell, right? The system is completely different. United States is a badly regulated monetary system. Bitcoin's a solution as always, right? So that's the lecture, I guess, period, to talk about this. We can add Bitcoin now in, right? So let's go back to the total money supply. All right. No matter how many times people say it, it doesn't make it correct. Why does it do that? I hate how the, hold on. Let me try to, there we go. Okay, this is M3 again. 36.3 trillion. Higher than what, my estimate is even higher than what the Fed published. And remember, mine does not include eurodollars. It says X eurodollars there. That should be part of M3, foreign offshore dollars. Could be 10 trillion higher than this. I just don't know yet. But you can say that you can do a calculation. What is Bitcoin's market cap? Okay, here it is. This is as of March. Very lagging indicator, but Bitcoin was 4.5% the value of M3 here. But that is not the right comparison. Because Bitcoin, as much as people don't want to admit it, will have a lot of these leverage instruments attached to it. It will. Now you have, options, open interest. We have futures. We have some exchanges that I'm sure are not fully backed. It is what it is. Withdraw your coins if you want full security. Use multi-sig. But this isn't really the number. The number is Bitcoin compared to the monetary base. Now you see a much higher percentage. But where's the monetary base? It's M0 and the bank reserves. So let's take off M3. That's the old Fed number that's not published. This is the number. Add these two up. About 5.7 trillion as of March. This is what Bitcoin is comparable to. And this is only America, right? We still have pound sterling, euros, yen, yuan, the major currencies, Swiss franc to add in here. This is what Bitcoin is going to be comparable to. And if you understand that, then you understand how amazing Bitcoin is. Because after 15 years, it is not only this small percentage, which would be the M3 penetration, but it is already, as far as the US is concerned, 28.3% of the dollar, of the Fed central bank money. So, hope that was clear as mud. Hope it wasn't too boring, but I have to get on this high horse, hobby horse all the time because I just hear it so much. Like, it's not M2, it's M3. When you think about the fiat money supply, it's this supply. It's not M2. M2 is not correct. There's a lot more dollars in the system than M2. A lot more. And they are going to keep at it. So I don't know you guys if you have any questions, but you know, here's our power curve on the log right now. Actually, I got to reset that. Hold on. So you can see Bitcoin growing on that old power curve. This is not the correct percentage. You can take off Fed repos. Technically, it's not central bank money. But hopefully you can understand now what I was saying about in this chart, right? They get involved in the market. The Fed gets involved in the non-bank market, in the non-bank private shadow bank market, hedge fund market, pension fund market, money market fund market is here. And it's usually to relieve some stress. But now that they're getting out of that market, you see number 4 rise quite rapidly. And that's a danger sign for sure. A lot of liquidity. Bitcoin is always going to be the answer, but again, I'm trying to show you the reality of how all this stuff looks. And it's also great businesses. Look, I mean, I understand why the Trump team wants to be issuing stablecoins. You know, Lutnick is telling them how amazing it is. Lutnick wants to penetrate this market right here. It's a $5 trillion market. It's money market funds. You just replace money market funds with stable coins, and it's a better technology. It's a better type of money. It's a better type of fiduciary media. And people can collect fees on that. That's all there is to it. But if you think this is going to zero, it's just not. Okay, so Tim, shadow bank repos, probably mentioned it earlier before you joined, but so again, this is only M3 money that's not part of M2. Everybody in Twitter says They just quote M2 because that's the easily available money supply. The Fed hasn't published M3 since 2006. But you see the delta here. Look here between number 2 and number 3 on this chart. There's $15 trillion of liquidity that is not being reported by the Fed, at least not directly. You have to painstakingly go through the numbers like me if you want to figure this out. So $15 trillion of liquidity that is for institutions. What's the difference between M2 and M3? M2 is basically all retail stuff. M3 is institutional stuff, hedge funds, pension funds. Okay. So I went through the stack here. Large time deposits, you know what that is. Basically, it's you deposit money a long time, like over 6 months, over a year. That's number one. $2.3 trillion of funds there. Number 2 is money market funds, basically like a stable coin, $5.3 trillion there. Now the repos. So again, just to repeat what I said earlier, this is commercial bank repos. This is what they used to put in M3. This is basically a levered up treasury. It's just trading around a United States Treasury bill, note, bond in a more levered fashion. Okay, so you can, if you're a hedge fund, you can short a treasury, you could long it, you could write options on it, you could make other loans, set it as collateral. All of that stuff happens in the repurchase agreement market. The Fed used to track it and put it in M3, right? But they would actually only use commercial bank repos, right? So the repos that were done in banks, sort of like above board, official, in a regulated fashion, because commercial banks are regulated very strictly by the Federal Reserve. But the repo market is much bigger than that. It includes a lot of institutions that are not banks. They may be related to banks, but they're not banks. So hedge funds, pension funds, money market funds themselves, actually. So it's it's pure leverage. This is a very dangerous market. This is pure leverage. This is basically taking a United States Treasury bill, note, or bond, attaching an additional debt instrument to it, and playing around with it. You could be lending overnight. You could be lending over 6 weeks, a year. And I find it very interesting that that this market, which they were not reporting, right, from 2006, was skyrocketing right before the GFC. All right, so I think that's a clue why they stopped publishing M3 back in 2006. So shadow bank repos are non-regulated banks playing leverage with the Treasury market. And by the way, there is some, like, I don't know how to say this. It's not exactly double counting, but the leverage is really high here. Okay, so let's take, for example, the money market fund and the shadow bank repo market. Okay, right here. What is that? Let me go here and here. I don't know why that keeps going negative, but whatever. So if you were a money market fund, which is basically, think of a stablecoin issuer. You're working with brokers, you're issuing these certificates, which are money market funds, and the funds that you get in response for issuing those certificates, you buy treasuries with. That's money market funds. Simple. It's like the stablecoin market. Like I said, it's a big market, 5.2 trillion. But often, money market funds themselves lever up to get higher interest than the treasury bond pays. And that's the repo market. So you could basically if you're the money market fund, the asset that you hold is the treasury against the United States government. You could swap that treasury with a fund that wants to short it or something. they promise you a higher interest rate, and the mechanism that you do that is a repurchase agreement, a repo. Then that gets counted in number 4 here. So it's not exactly double counting, it's just extra leverage. That's what it is. And that's how you count up the money supply. So you count up all the different liabilities that are created by institutions, and that will be the money supply. I hope that's starting to make sense, or it does make sense, but it's you can think of both of these, frankly, both number 2 and number 4 here, and number 3, which is just commercial bank stuff, as Treasury bonds that are trading around like cash and additional levels of risk attached to them. So it's a big portion if you think about it. All right, so, and I should probably just do a chart like this. I don't think I even have it, but these 3 items, number 2, 3, and 4, that you could take the total value of this, which at the moment is $12 trillion, and you could divide that by the national debt. And that would show you sort of the levered Wall Street market that's playing around with treasuries. That's what it is. It's different ways of passing around treasuries and trying to earn more interest on this asset that one of these parties holds. If you're the safe person, the asset, you're the reverse repo holder. If you're the person taking risk, you're the repo holder. And that's the repo market. I probably should do that, actually. This is why I like talking with you guys, is I just think of these things on the fly. But pretty small leverage here. Some data doesn't even start. Like here, obviously started. Which one just started? Commercial bank repos. They started in the 70s, the data. It was shadow bank repos or brokers. There's probably some commercial banks too. They don't have the data, so whatever. Data gets pretty bad as you go back in time, but we could add all 3 of these together and find a number that would be like Wall Street playing with treasuries, basically, and divided by the national debt. I guess to be fair, you can repo things that are not treasuries. Like you can repo stocks, like literally shares of stock. You could repo gold. So that's another thing I didn't even think about. But the vast majority of all of this is a United States Treasury bill, note, or bond. So I think you could probably for convenience sake, show that relationship, show that ratio. It's probably something I should do. Because if you look at this chart, which I'll pull up in a second. All right, so here's the debt. We've shown this a lot, right? This is a different way to slice it up, but let's take off this. I've shown this a lot, right? Let's just look in the last 15 years. These 3 lines are different holders of debt. It's a totally different analysis. I mean, it's not totally different, but this is ownership, by ownership. So we have the Fed at the moment holds 18%, 17.6%, you see, the tooltip. Foreigners hold 24%, and then the rest, Americans that aren't the Fed, hold 58%. So what I could do is I could show a ratio of these things. And we can kind of see how leveraged. It's actually probably a good idea. Because obviously you can see that the leverage, this is pure leverage. It's pure leverage. So you can see the leverage increases here before the crisis, and it's increasing now. So and you would need to count this too, the Fed. The Fed has repoed as well. But it's negative on the money supply because the Federal Reserve is never included in the broader money supplies. Not for the monetary base, not for repos, but it's, like I said, they take liquidity out of the system. This is bailout money, basically. Hi, Demetrius. Yes. Yeah, just different analysis. So if you go back here, obviously what backs most of M2 is, like you say, loans. It's the banking system. M0, which is the physical notes, that is backed by treasuries, as you know. Most of what the Fed holds is treasuries as an asset. But yeah, this is basically what you would think is of the banking system is M2, and then really when you get into M3, it is a lot of leverage on treasuries. The exact amount, I don't know, but I think you could probably just assume 100% is in treasuries, and you'd still get some interesting ratio to look at. So I should do that, frankly. But this number, by the way, again, just to be clear, the repos, this was not published until Dodd-Frank. And they're just so goofy how they do it. Like here you can see, this is the banking repo, which is not a big sector. Just repoing treasuries through the banking system. Wall Street doesn't like to do that. It's kind of slow. It's not that big. This was what was included in M3 before. They didn't include the shadow bank repos. And then they didn't even include this data here from 2006 to 2012. It's just like, it's laughable. So you have to sort of regress it and find it. But you can back into a total repo number, which includes this, this, and this. This is the repo market. So again, just to repeat and answer your question, it's just levered. It's levered up treasuries. It's treasury market working at hyper Wall Street speed to make some people money and to lose other people more money, probably at the end of the day. And we should include this as institutional money market funds because that's they're going to mostly be in treasuries as well. So you get to a number that's 11, 12 trillion. Then we go back to here. Oops. Where is it? Here. 11, 12 trillion, you know, is a third. It's a third of the U.S. debt pile. So this is good. I can show this tomorrow now. That is highly liquid, but also highly risky, I think, circulations of the U.S. debt. And I do think that it's somewhat, you know, I don't know. Like, I don't know how predictable it was here. Here you see, this is bad data. It's not that much data, but at least from what the sea change that we saw in 2008, like this was a pretty interesting indicator. I mean, it was at least going crazy, right? You can see it in the multiple here. This is total M3 divided by total Federal Reserve liabilities, including their own repos that they repo with the system. So it's pretty high multiple. My conclusion always with all this, because I know it can be overwhelming to people that don't really think about this stuff as much as I do, but my conclusion remains Bitcoin. So can't say it enough. We're very lucky to have it. But also, there's no way this is going away. There's no way, like, the government's going to give up the Treasury market. The government's going to give up the dollar. This stuff is going to be, we're going to have to deal with this stuff for a long time until we get to a Bitcoin standard. Remember, this is just the Fed ownership portion of the debt, right? They got room in the, they got ammo for the bazooka now if they want. Trump already wants Powell to do it, but they were close to 30% ownership of the debt. Now they're only down to 18. So if shit hits the fan, they're going to do it. They're going to print more. Yes, sir. I'm very sympathetic to the Austrian school, but you can't regulate it. I mean, you can't, if you want less regulation, you're going to get more risk. It's usually how it works. Just think about the puking that we had in the Bitcoin network over the last 15 years. And okay, Bitcoin and crypto, but it still happened, with Bitcoin or in the name of Bitcoin. There's no doubt in my mind that's going to happen in the next cycle as well. But Bitcoin's so great because we can just withdraw 99% of it. And if you want to gamble, gamble 1% of it. On the flip side, and this is a bit economic, this is deep into the economic theory, but if you follow, the credit theory of money, which I generally do, if we all hoarded our gold, there would be no economic activity. We could pay for things with gold and just pay, like that's it. But the activity would only be as much as the circulation of gold coins. It's never worked that way. Banks usually lever up the gold, only store a portion in the vault, and then off we go. You create more loans than there is base money in the system, and off we go. George Selgin writes about this a lot. He writes how Adam Smith writes about this. I think it's book 7 of The Wealth of Nations, where he talks about how that was actually one of the saving graces of Scotland, a country that became a free banking sort of test case, because they really utilized the banking system to grow their economy. Wasn't without pain and wasn't without, crises at times, but most people don't prefer to use gold for everyday spending and transacting. Even 300 years ago, they just didn't prefer to hold the coins in their pockets or whatever. You do bills of credits, you'd sign over checks, or you'd just paper notes. And there, even in Scotland today, I think those 4 banks, RBS, I should know the rest, but I don't. These 4 banks in Scotland, the main banks, they all have the right to print notes. It doesn't mean anything like it used to, but when they didn't have a central bank, you'd have major, you'd have different pictures, different banknotes for the same pound gold standard, which was interesting. I think something like that will come with Bitcoin. You'll have Coinbase substitutes. Obviously, we have Lightning, which is way easier, but you got fees to deal with there too. But you'll have Coinbase substitutes, Kraken substitutes. Those guys are going to go against the banking system regulations. It's going to take a long time, but I think we'll give it another try. Probably will blow up, and then we'll get the government to come and regulate again. But as long as you can withdraw that Bitcoin, you have a level of safety that no other system could have. I'm starting to drone on about fractional reserve banking, so if anybody has anything else, let me know. But yeah, I have to think about this a bit more. But I think you wouldn't do it for large time deposits. But I think with these 3, it's a good actually numerator denominator relationship. This would be the numerator, and the national debt would be the denominator. And we see how that ratio shakes out. Have it at least back to the 50s. But it's not going to be great data from the 50s, frankly. Or the 60s. As you see, stuff was kind of primitive. Time deposits made more sense. People understood that, but repos, money market funds wasn't really happening back in the 60s and 70s. Just for Baltic security, I have to do it. Great fan of this man, Tomas Ilves, former president of Estonia, American, studied in Columbia. Big part of their, he's a coder, part of their digital sort of Estonia's e-infrastructure. Says it took 35 years, but he finally heard it from Germany, NATO. For too long, we in Germany didn't want to hear our Baltic neighbors' warnings about Russia's imperialist policies. We have recognized this mistake, and there's no going back from this realization. If any German friends are listening, I can't tell you how lucky we are that it's Merz at the moment. I know I'm looking from the outside, but if this was an AFD government or the Schultz government, I mean, we just have more head in the sand. And the wild thing is we only have Germany so far. I mean, I know Macron talks a big game for all of Europe, but this is very nice to see, and we'll have to see how it goes. But this continues to be the reality that I think about with my family, let alone thinking about the banking system. So my goal is, I was thinking about this a lot because, I mostly show the dollar here. My goal is to give you the broadest money supplies for the dollar, the euro, the yen. Maybe not the yuan at this point. They have it, but they're such a crazy economy. It's going to skew things even, but the Swiss franc. Those are the main liquid currencies, and show you the relationship of sort of how levered all those systems are. both versus debt and versus the monetary base. Taking M3 versus the monetary base. They're all going to be a little bit different. And if you look at this one, this is just bonkers, really. I mean, we're in a totally different world now. Where broad money basically is only 8.7x base money. Before the crisis, it was 115x. What does that mean for the next crisis? I don't exactly know. Are they going to print more and take this multiple down to like 2x? What was the minimum? I think it was here. The minimum was 5x. And that's M3 money. It's total Fed balance sheet, basically, TFL, total Fed liabilities, divided by M3. Good morning, Daniel. I can try, yeah. I mean, it's always outpaced, meaning the other things outpace tax, as you know. The average is 20 cents on the dollar deficit. So they take in $1 of tax, spend $1, and then spend 20 cents more and increase the debt. That's what the average is. But I know what you mean, like sort of breaking it down by function. Oh, the interest, yeah. Mm-hmm. Yeah. I mean, the brass tacks is still kind of as I have it there. Let me pull it up. This is still kind of brass tacks. So here's the interest. It's a different chart. I can do it. I know what you mean, but basically 20 cents on each dollar tax is interest, right? Which is actually not the highest, but I'm not saying it's a good thing, as we know it's huge and it's going to continue to grow. So 22 cents on the dollar tax is interest. That means 78 cents to pay for everything else. And we know that they don't do that. They actually pay 78 cents plus, at the moment, another 30 cents. So it's confusing, sort of the way to look at all these things. But you're looking to see, that chart with all the payments broken out. But I can do it. I can try to do something like that because I think it'd be helpful. MB is monetary base. Monetary base, sir. So you'll have to go back and look at the beginning, but the monetary base is what is comparable to Bitcoin, not broad money. So broad money is what's called M3 or M2. Some different institutions use either. Sometimes M2, sometimes M3. You should use M3 because that includes institutional deposits and retail deposits. That's number 3. But Bitcoin is really, in reality, not comparable to that. It's only comparable to this, which is the very core of the system. This is central bank money. Let me take out this. This is really the base of it. It's 2 things. It's cash, which is physical cash, which CBDC is included there too, by the way, but that's still so small, and China has one. Not many people are like really working it, but CBDC would be included in this. But physical cash, like those notes, coins, that's in the US, that's 2.2 trillion, as you see right there in the tooltip. And then what you have, which we don't have access to, is this. This is like digital cash, but digital cash for banks. It's what banks make loans off of. This is 3.5 trillion. So add these two together. That's 5.7 trillion, 5.8 trillion. That is the monetary base. That is what is comparable to Bitcoin. And so you see this percentage. Looking only at the US, Bitcoin is already 28% of the monetary base, which is amazing. It's incredible. We'd still have to count up all the other monetary bases around the world, like for the euro, for the yen, yuan. And I have that research, but I'm not going to show that right now. Thank you for the repost. Thank you very much. So it's hardcore on the money supply today. If you want to talk fiat, look at broad money. That is M3 broad money, not M2. M2 does not include everything. Federal Reserve doesn't publish it, so stick with me. I'll help you. It's about 36 trillion is the amount of broad money in the United States, and that does not even include broad money outside the United States, which would be eurodollars, which are offshore dollars. So dollars in the Caribbean, in Taiwan, in China, wherever there are dollars. And by the way, I don't mean physical dollars. That's included in the M0, even actually. But wherever there are dollar deposits, okay, so you can think of the Panama Papers or the Paradise Papers or any of these leaks. A lot of that stuff was a dollar deposit. That's an offshore dollar. That's a euro dollar. That also should be part of M3. It used to be, but it was a very like poorly calculated one. So you can see that my M3 is even bigger than theirs, but it's a long story. You have to go back to the beginning to look at it. But basically, this stuff didn't start to become clear until somewhere here, 2012, 2013. The Fed did a lot of work because of Dodd-Frank to make their monetary governance more clear. So you can back into an old M3 supply, which is even higher, what they said. But, as I said, my M3, as you see in the tooltip, does not include eurodollars. So there's even more dollars than this sloshing around the world. And again, to talk about this post, as Nick says, crypto dollarization, or what the Genius Act says, Besant says he thinks stablecoins are going to reach within 10 years at least $3.7 trillion worth. That is going to attack this segment, which is institutional money market funds. Also retail money market funds, but that's an M2. I'm just showing you M3. So it's $5 trillion. And it's also going to attack the eurodollar market. Stablecoins will be, they're kind of a blend of a money market fund, and obviously it's eurodollars because this is a dollar instrument that's outside of the control of the Federal Reserve. And your guess is as good as mine about how big the eurodollar market is. It's at least 10 trillion. So brass tacks, the dollar market is 36 trillion without eurodollars. You add eurodollars, maybe 50 trillion. I don't know. No one knows. Not even the Fed knows, I think. Fed might know, but they have a better idea than I do. I've heard many estimates. Some people think the eurodollar market's like 50 trillion, but I don't know about that. But yeah, this is how the money supply works. This is how you count things up. But even though we talk about inflation and money and how Bitcoin's going to attack all that, Bitcoin is not, it's not an apples to apples comparison to M3. It's only comparable to MB, which is here. So I know I sound like a broken record for those of you that have been listening long enough, but it's important to understand that distinction because this is central bank money. It's the same concept in any other central bank, and this is what Bitcoin is attacking. Then we can go back to this chart, which is, I can add all of it up for you basically. Which I've shown many times. I showed this at BTC Prague as well. This is the ultimate chart. So if we count up all available gold and silver, and we count up the monetary base, which I just talked about globally, you also have to remove, this says, I can take up my picture off, but this says remove gold and Bitcoin reserves. You can't double count what they're holding. So basically it's two assets, gold and silver, plus a big liability for central banks that aren't backed by those same assets. You'll get this value, which is here. As of May, my estimate is $43.3 trillion. This is base money that's comparable to Bitcoin worldwide, all currencies. Bitcoin, by the way, you can see that this is exponential growth because it's a straight line. I got the regression going out, but just the actual data in the past, you can clearly see it's exponential. Bitcoin doesn't grow like that. Bitcoin grows like a network, so it's going to be slower to achieve it, but it still grows at a very fast rate. And right now, as of May, month end May, we're about 2 trillion versus 43 trillion, or 4.8% of the total. And we pull this out. My best estimate when it crosses is 2043. $155 trillion. Of course, 1,000 things could change. Until this point, I'm not saying that this is gospel or anything, but it's just to give you an idea of how the monetary landscape looks compared to Bitcoin. And I'm throwing all these data points out at you just to get more comfortable in the idea that it's probably going to take some time. So don't hyperventilate. When Bitcoin goes to 150,000 in a week, which it could, or falls back down to 75,000 in 2 weeks, which it could. It's on a pretty good trend here. And probably somewhere here, in my view, like 10 years out, 2 halvings out, 2 to 3 halvings, I think we're going to have something like a Bitcoin standard start to make sense. At least probably somewhere, probably many places around the world, you're going to really have sats be understood as like a pricing mechanism. And then we just see what happens. Yeah, I think it's amazing. I think it's amazing. And if you understand that it's base money and not broad money, then even if you look at, say, any one currency like the dollar, we're way closer than people think. Like if I did it as a percentage of M3, it's way lower, right? Only, it's actually about the same number, oddly, but that's a totally different thing. 4.5% of M3 is the Bitcoin network. But that's not comparable to anything. Remember, this light green area is like a dollar. It's like a stable coin, right? I don't know any other way to say it. I mean, it's a derived dollar balance formed by institutions who are taking risk. Theoretically, this is no risk. Let's take off the old M3 crap. They didn't publish this. Theoretically, this is no risk. This is the central bank money. And theoretically, this is all the risk. This is M3 money. But like I said, it doesn't include eurodollars, so it's even probably 10 trillion bigger. There will be risky Bitcoin certificates for sure in the future. There already are. There already has been, based on all the exchange problems, some of the hacks, some of the defaults, some of the scams. There will be more. So it's just a question of risk, in my view. If you play in these markets, obviously you can make big money, but you could also lose a lot of money. So that's the game. As you said, Tim, the games we play. I wish I could show you this, more often or faster. But like I said, because of the lack of clarity from the Federal Reserve, I can only put this M3 money supply together for you on a quarterly basis. All right, guys. Got some other things to do. And actually, I will not be able to stream tomorrow. Some other work. But I will. I promise you on Friday, I'll be back and we'll look at these 3 items, which are part of M3. It's really geeky stuff, right? I literally just thought about it on this stream. It would be good to, assuming that these instruments are completely backed by treasuries, which most of them are. Not. There's probably some golds, probably some stocks in some of this, but most is treasuries here. I'll put a ratio of this versus the debt, and we can see how the leverage looks. To be clear, and this is part of M3, this is the main part of M3, repos and money market funds. These are simply, as an instrument, they could represent something like a stablecoin, mostly for money market funds, but as a function of risk, they're taking more risk on the treasury than the interest that the treasury will get from itself. So it's literally risk upon risk. That's what this is. So, thank you, Daniel. Thank you guys for watching. Let me know if you want to see anything else in the future, other charts. I guess I should start to say this now because, again, I'm the anti-newsletter guy, but you can support me right here. If you want to just throw a few sats, Lightning or on-chain, no problem. On my website, right on this bar. Everything else is free otherwise. So, thank you, Tim. U.S. Treasuries are the dominant form of collateral in the repo market, represent about 2/3 of the total. I'll have to drill down and see where they got that. That's interesting. I would expect even more. But yeah, interesting. All right, guys. Thank you. Appreciate it. Talk to you on Friday.